Hello everybody. This video will set about the best 10 ways for investment. Number 1. High-yield savings accounts. Online savings accounts and cash management accounts provide higher rates of return than you'll get during a traditional bank savings or bank account. Cash management accounts are sort of a savings account checking account hybrid. They'll pay interest rates almost like savings accounts, but are typically offered by brokerage firms and should come with debit cards or checks. Best for savings accounts are best for short-term savings or money you would like to access only occasionally. Think an emergency or vacation fund. Transactions from a bank account are limited to 6 per month. Cash management accounts offer more flexibility and similar, or in some cases, higher interest rates. Number 2. Certificates of deposit. A CD may be a federally insured bank account that gives a hard and fast rate of interest for an outlined period of your time. Best for a CD is for money you recognize you'll need in a hard and fast date within the future. Common term lengths are 1, 3, and 5 years, so if you're trying to securely grow your money for a selected purpose within a predetermined time frame, CDs could be a good option. It's important to notice, though, that to urge your money out of a CD early, you'll likely need to pay a fee. As with other sorts of investments, don't buy a CD with money you would possibly need soon. Money market funds. Money market mutual funds are an investment product, to not be confused with market accounts, which are deposit accounts almost like savings accounts. When you invest during a market fund, your money buys a set of high, short-term government, bank or corporate debt. Best for money you'll need soon that you're willing to show to a touch more market risk. Investors also use market funds to carry some of their portfolio during a safer investment than stocks, or as a holding pen for money earmarked for future investment. Number 4. Government bonds. A bond may be a loan from you to a government entity that pays investors interest on the loan over a group period of time, typically 1 to 30 years. Because of that steady stream of payments, bonds are referred to as a fixed income security. Government bonds are virtually a risk-free investment, as they're backed by the complete faith and credit of the U.S. government. 5. Corporate bonds. Corporate bonds operate within the same way as government bonds, only you're making a loan to a corporation, not a government. As such, these loans aren't backed by the government, making them a riskier option. And if it's a junk bond, these can actually be substantially riskier, taking over a risk-return profile that more resembles stocks than bonds. Mutual funds. Their money across multiple investments to hedge against any single investment's losses. Number 7. Index funds. An index fund is a type of mutual fund that holds the stocks in a particular market index. The aim is to supply investment returns adequate to the underlying index's performance, as against an actively managed open-end fund that pays knowledgeable to curate a fund's holdings. Best for index mutual funds are a number of the simplest investments available for long-term savings goals. In addition to being less expensive thanks to lower fund management fees, index mutual funds are less volatile than actively managed funds that attempt to beat the market. Number 8. Exchange-traded funds. ETFs are like mutual funds therein they pool investor money to shop for a set of securities, providing one diversified investment. The difference is how they're sold. Investors buy shares of ETFs a bit like they might buy shares of a private stock. Best for, like index funds and mutual funds, ETFs are a good investment if you have a long time horizon. Beyond that, ETFs are ideal for investors who don't have enough money to satisfy the minimum investment requirements for an open-end fund, because an ETF share price could also be lower than a mutual fund minimum. Number 9. Dividend stocks. Dividend stocks can provide the fixed income of bonds also because the growth of individual stocks and stock funds. Dividends are regular cash payments companies pay to shareholders and are often related to stable, profitable companies. While share prices of some dividend stocks might not rise as high or quickly as growth stage companies, They will be attractive to investors due to the dividends and stability they provide. Number 10. Individual stocks. A stock represents a share of ownership during a company. Stocks offer the most important potential return on your investment while exposing your money to the very best level of volatility. These cautionary words aren't meant to scare you far away from stocks. Rather, they're meant to guide you toward the diversification that purchasing a set of stocks through mutual funds provides, as against buying individual. At end video, not forget subscribe and like for channel. Goodbye.